And good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and it's good to be back with the markets. But I think nothing much has changed with respect to the prices, although there's been quite a lot of things which has happened over the past week. We've got the US debt ceiling getting concluded, a mixed bag of jobs number being released on Friday, with the headline numbers being high, but the unemployment numbers also were high. Even the wage pressure was reducing. So wonder what sort of interpretation would FOMC be having on this front with respect to the JABES, with respect to the rate hike. There's a new term being talked about being a skip in the interest rate cycle, apart from the pause. OPEC talks also deepen. OPEC has been talking about deepening cuts, and India scales new highs in oil imports from Russia. So, JK, I'd like to know from you, with such developments, what should we be expecting?
Good morning, Shikhar. Uh, yes, we of course, even as we start event-filled week once again, we look back on last week with two important, in fact, three important developments. One is the jobs data in the US, and then the signing of the debt ceiling extension deal by the president, and then the OPEC meeting outcome. All of them do have some implication because the jobs data, in fact, has some implication for the monetary policy uh, coming in a mixed manner. Number of jobs created being far higher than expected. In fact, April job numbers was also being revised up. Unemployment rate was down. Again, they are up, but again, it's being pinned down to more number of people seeking jobs. And yes, the year-on-year inflation on wages was down by 0.1%. On debt ceiling, of course, we had the final signing by the president, and went through the House and the Senate without last-minute glitches. That was a good thing, but uh, well, unlike what most people expected, the buying of dollars have not abated even after that event, because the yields have been going up substantially since Friday, and that has more to do with the way liquidity is going to be, demand from the market. Treasury is going to issue a lot of T-bills and bonds to not only to meet their commitments, but also to replenish their own treasury general account. And then we had the OPEC meeting where there was no general agreement on an output cut, but they did agree to extend the earlier output cut from end of 2023 to end of 2024. And Saudi single-handedly also agreed to cut its output from July of this year by 1 million barrels per day. This obviously, oil prices have gone up. Brent went up by almost 10% from the low of last week. And the point is, important point is how they assess the demand for oil going forward, because we have to see major recession signs in the economies, but there are early hints, and if we do see a bigger slowdown, demand might ease even further. And as I understand from some specialists, they do not have much scope for cutting output further. So it really boils down to how the global economy evolves going forward. Now, all of this definitely have some bearing on the monetary policy also. In fact, the Fed members have been saying that June will be a skip, and they will reassess for July. But then the jobs data might, maybe making them rethink. But again, since we are into the blackout period ahead of Fed meeting this week, we don't have, we will not have an update from them. Sorry, Fed meeting is next week, but we will not have an update from them till the meeting is over. So the new view of the Fed after jobs data is not available for us. But there is a kind of controversy at play as far as the US economy is concerned. The service sector is improving substantially, whereas the manufacturing is still lagging. There is a big gap between hard production data, consumption data, and soft survey data. So the hard data have all surprised to the upside lately, while the opposite is true of the soft data. And looking at the composite leading indicators such as the conference board confidence, jobless claims, manufacturers' new orders, building permits, equity market, and interest rate, the message is one of recession. On the other side, the coincident indicators have been showing a robust robust picture. So we do not know how the monetary policy is going to evolve. There's huge uncertainty. At the same time, in Europe, we have inflation falling and the growth picture also eroding. So we have, but ECB is not convinced that they will reach the 2% inflation target that easily. So whether they will give more importance to the growth, where even the demand for loans has been coming down drastically, and all the forward-looking indicators are weak. So will ECB ignore growth and go for still the inflation target? So central banks are in a kind of fix in the monetary policy. I think this is the right time for them to go, at least for the Fed, go for a skip this meeting and then reassess how things. Probably they get a better picture, including the inflation and growth. So ECB obviously is not going to skip. They are definitely going to hike this week. So this is the what is guiding the overall markets now. Stock markets have rallied. Obviously, it's a relief rally which has started even before the signing of the deal. But how long it holds in the face of slowing the economies and also the higher interest rates is something that we need to wait and assess. And also the Japanese numbers. Again, this Monday we have had another surprise to the upside from the services side. So they are not again showing any sign of tweaking their policy again. But at the same time, logic it defies logic, because every number has come good and their inflation is also rising, but monetary policy is not going in the direction that it is expected to go. So we are in a very a situation where huge uncertainty as far as the monetary policy is concerned and the economy is concerned. So that is where we are starting this week with. Of course, we have more policy decisions. We have Australian central bank meeting tomorrow. We have the Canadian central bank meeting on Wednesday. Mostly both of them go for kind of hawkish pass. That is the market expectation. So it's once again something that people cannot take a firm view. This is where the this one monetary policy is going. Yes, as I said earlier, we did have a big move up in the yields on Friday. 2-year went up by 20 basis points and 10-year went up by 10 basis points. And dollar could not ignore this move higher in the yields. Dollar index went up by 0.5%. Euro dropped below 107 once again. Not surprising, because European yields have not caught up with the USD, and the yield differential between US and Europe has once again widened in favor of the USD. Commodity currencies did recover, particularly Canadian dollar on the back of oil price rally. Australian dollar formed up because of a strong jobs report, increasing the risk prone sentiment, as well as Australian wage setting body announcing that they are raising the minimum wage by 5.75%. So at the same time, we have a curve inversion between US 2-year and 10-year, which has deepened to 83 basis points. So more confusion for analysts whether we are again moving towards a steeper recession or whether taking more time. So we are in a very uncertain situation. In the meantime, USD-INR, of course, we did fall to the next support at 82.30 on Friday, but was very well held, because again PSU bank bids were appearing And with the dollar index again moving back up, it's unlikely that the lower supports at 80 to 2030 is going to be broken that easily. We don't expect any big impact from the oil price, high oil price going up, or even the OPEC decision going forward, because even now oil market seems to be very well supplied. But factor for INR would be definitely the FI flow. Last month we had very good flow of more than 5 billion, just the highest number after 9 months. This month we have started with a small negative. That is something we need to wait and watch. And RBI decision, of course, on Friday, where the wide expectation is for a continued pause by the central bank. So rupee, definitely they hold in a range or in a stable range, broadly following the dollar index with a lag, perhaps. And that's how we see the rupee once again in this week, at least trading between 82 and 82.80. It's difficult to see it breaking either of these ranges that easily. Thank you.
Okay, JK, that was quite good. And yes, folks, with respect to our currency, it's going to continue to trade in a range as per expectations, as JK mentioned, between 82 and 82.80. And with respect to our central bank, we have the monetary policy meeting this week, and major expectations or market-wide expectations continue to be of a pause. But if we talk about the central bank's activity, it is the European Central Bank who is in a fix. Although a hike is being discounted pretty well, it's the long-term picture or the long-term visibility which needs to be seen, as the European inflation is coming down, but also is the growth picture eroding. And it's not just European, but also the recession across the globe. Expectations of recession would further influence the kind of output cuts OPEC and OPEC Plus would be looking for, because the demand continues to be on the lower side and the supply, as JK mentioned, is quite good. With respect to the US, as we all heard, the buying of dollar has not yet abated, and we have also seen some bit of yields having moved, have continued to rather move higher. Now, this is also on the backdrop of all the US debt ceiling negotiations and the jobs number being released, along with the FOMC being in the next week scheduled, along with the inflation numbers. Now, there's a blackout period which prevents us from obtaining the views of the Fed governors, but let's see how things go about in the next week. Till then, we shall continue watching the kind of updates we are receiving as of now. That's it for today, folks. Thank you so much for listening, and we shall come back again tomorrow.